Welcome to the deep dive. Today, we're undertaking a really forensic analysis of a company that I think embodies the ultimate binary trade, Summit Therapeutics. We're not just looking at a stock ticker here. We are mapping a high-stakes chess match.
Absolutely. A match between a proven billionaire legend and, well, the most rigorous regulatory body in the world, the FDA.
And the stakes could not be higher. You have the, $25 billion reigning champion of cancer treatment, Keytruda. I mean, it's the gold standard of modern oncology.
It is. And the question on the table is, could a small pre-revenue challenger not only match that drug, but fundamentally beat it? Beat it on efficacy.
That potential sent the market soaring. Summit's drug candidate, Ivonescimab, delivered this clinical victory in China that was, frankly, just staggering.
A 49% reduction in the risk of disease progression. That number is almost unheard of.
It is. But here's the central tension. The reason the stock is so incredibly volatile, the very same drug is now facing massive regulatory skepticism.
Right. And it's skepticism over the ultimate metric of success, which is overall survival data.
Especially when that data comes primarily from overseas trials.
Exactly. So Summit Therapeutics, the ticker is SMMT, currently commands a $13.6 billion market cap as of today, December 8, 2025.
Which is a massive valuation. It reflects just enormous future potential.
But, and this is the big but, the company has zero commercial revenue.
Zero.
This is not some gradual investment. It's purely binary. You're betting on a single regulatory decision that determines whether this company is worth, say, $50 a share or $5.
So our mission today is to give you a shortcut to being really well informed on this high-risk gamble. We're going to break down SMMT's business model, the unique kind of complex science that gives Ivonescimab its edge.
The billionaire CEO Robert Duggan's famous playbook, and all the complex geopolitical and regulatory risks.
Right, including that recent scrutiny from the Biosecure Act, which really defines Summit's future. The current price is sitting around $18.31, and we aim to figure out if the market is correctly pricing in the risk of failure or if this is, a classic asymmetric opportunity.
Okay, let's really unpack this enormous tension between the risk and the potential reward. I think we have to start where all the value truly lies, the asset itself and the business structure that acquired it.
Let's start the deep dive, part 1, chapters 1 to 3, business, management, and financials. Chapter 1, Business Understanding. So when you look at a $13.6 billion market cap, you usually expect a company to look like, a Pfizer or a Merck.
Right. Massive global infrastructure, sprawling labs, a huge sales force.
Exactly. But Summit Therapeutics is the total opposite. They are pre-commercial in the Western Hemisphere. So what exactly is their operational model?
Their model is built entirely around leverage, which is why we're calling them the Western Bridge for Eastern innovation.
Okay. What does that mean in practice?
It means Summit's business model is not drug discovery from scratch. It's licensing and development. So instead of spending a decade and billions of dollars developing a molecule, from the ground up,
They go shopping.
They strategically acquired a molecule that was already far along in clinical testing. And in doing so, they skipped the most risky, most expensive early stages of drug development.
So they essentially looked around the world for a top-tier asset that was ready for the big leagues. And this all culminated in that crucial December 2022 deal.
That's the one, the deal with Akeso Inc., a really significant Chinese biotech pioneer.
And that deal granted Summit the exclusive rights to develop and commercialize the asset, Ivonescimab, but not everywhere.
Correct. Only in the most lucrative pharmaceutical territories globally. So we're talking the U.S., Canada, Europe, and Japan.
And Akeso.
Akeso retains the rights for the vast Chinese domestic market and, the rest of the world. This arrangement is a powerful form of strategic arbitrage.
So Summit takes a drug that's already shown promise and applies its regulatory expertise and its huge war chest to get Western approval.
Exactly. They're securing the premium pricing markets.
And as we said, their current state is zero commercial revenue. They are a pure expense engine.
A great way to put it. Every single dollar flowing through that company right now is going toward R&D, clinical trial execution, and regulatory prep.
The clock is ticking, and the cash burn is focused entirely on this one product.
And that product is everything. The entire $13.6 billion valuation rests on their single key asset, Ivonescimab, also known as SMT-112.
We have to stress this. This is the definition of single asset risk.
It absolutely is.
Yeah.
But it's also why the opportunity, if they succeed, is so profound.
So to understand why this one drug is potentially worth billions, we have to get into the science. And this is where it differs fundamentally from something like Keytruda. Keytruda and drugs like it are PD-1 checkpoint inhibitors. They essentially take the blinders off the immune system so it can see the cancer that was hiding. Ivonescimab is different. It's a bispecific antibody.
That's right. And bispecific just means it attacks two targets at the same time.
Okay, so what are the two targets?
So it hits PD-1, just like Keytruda does, to activate the immune system. But it also hits VEGF,
VEGF.
vascular endothelial growth factor. Basically, VEGF is the signal that tells tumors to grow new blood vessels to feed themselves.
So it's like cutting off their supply lines.
You're starving the tumor of the nutrients and oxygen it needs to survive. You inhibit VEGF, you start to starve it.
And traditionally, to get this kind of dual effect, a doctor would have to give a patient two separate IV infusions, a PD-1 drug and a VEGF inhibitor.
Which complicates everything. Logistics, risks, pricing, scheduling for the patient. It's a huge burden.
And this is where we get to the unique scientific moat that Summit has. Ivonescimab isn't just bispecific, it's tetravalent.
Right, and that's a key word, tetravalent. It means that instead of just two binding sites, one for PD-1 and one for VEGF, has four. Two for PD-1 and two for VEGF.
So why does having two extra binding sites actually matter? Is it just, a marginally better drug, or is this a real structural game changer?
It is a critical structural differentiator. This is the core of their intellectual property. The tetravalent structure enables what scientists call cooperative binding.
Okay, break that down for us. Cooperative binding.
Think of it this way. In a tumor, both the PD-1 and VEGF pathways are highly expressed right there in the immediate tumor microenvironment.
Okay.
So if your drug molecule has two different hands, one for PD-1 and one for VEGF, it becomes much more likely to grab on and concentrate right at the site of the tumor.
And with the tetravalent structure, having four hands.
It becomes exponentially stickier. It's more efficient at that specific site. It's like a magnet that's twice as strong, but only in the one place you need it.
It's like a GPS system that only activates when it picks up two different satellite signals at the same time, ensuring it's in the exact right spot.
That's a perfect analogy.
Yeah.
And this focused binding theoretically concentrates the anti-tumor effect precisely where it's needed, which could make it more effective than two separate drugs just floating around systemically.
And just as important, it means it can be administered as a combo in a vial.
One infusion. It simplifies inventory, logistics, dosage. It potentially reduces the administrative burden and the risk profile compared to managing two separate drugs.
That is a huge operational advantage for any busy oncology practice.
Absolutely massive.
So if we look at the market position and scale here, Summit isn't going after some niche disease.
No, not at all. They are targeting the biggest game in the forest, non-small cell lung cancer, or NSCLC.
Lung cancer is the leading cause of cancer death globally, and NSCLC makes up, about 85% of those cases?
That's right. It's an enormous patient population, and their strategic objective here is crystal clear.
They want to replace Keytruda.
They are explicitly trying to replace Keytruda in the first-line treatment setting. Keytruda is the biggest drug in the world, generating over $25 billion a year for Merck.
So even a small slice of that pie is transformative.
If Ivonescimab can capture even a fraction of that market, let's say 10%, that is instantly a multi-billion-dollar drug for Summit.
Which explains the potential peak sales estimates. They're all over the place.
They really are. We see estimates ranging from a conservative $1.7 billion if they only get approved for one narrow indication.
All the way up to over $10 billion annually.
And that's the bull case. That's if they achieve broad adoption in first-line NSCLC and successfully expand into other high-value indications like colorectal or breast cancer, which they're already testing.
So the primary value proposition is simple: better efficacy.
Better efficacy through combination biology, delivered via superior molecular architecture. And the data from the early trials is what truly captivated the market and, put Summit on the map.
Let's really drill down into that data. The HARMONi-2 trial in China, that was a head-to-head comparison against Keytruda monotherapy in first-line NSCLC.
Correct.
And the key takeaway, the staggering stat, was Ivonescimab's ability to reduce the risk of disease progression or death,
which is known as progression-free survival, or PFS.
by a massive 49% compared to Keytruda.
And to put that number in perspective for you, in oncology, A drug that shows a 15% 1.5 improvement in PFS is generally celebrated. It's a win.
Right.
A 49% risk reduction is a historical outlier. It suggests a profound clinical benefit.
And the other metrics were just as good.
They were. The overall response rate, or ORR, that's the percentage of patients whose tumor shrinks significantly, went up by 11.5%.
From 38.5% to 50%.
Right. And the disease control rate, the DCR, jumped nearly 20 points from 70.5% all the way up to 89.9%.
So this all sounds like an absolute slam dunk, but this is where the regulatory minefield opens up.
It is.
Why, if the data is so overwhelmingly positive on PFS, is the market not already pricing this stock at $50?
The problem is really twofold. First, all of that amazing data we just talked about came from a China-only trial.
And the FDA does not like that.
Not anymore. After some past issues, the FDA has been very clear that it is highly skeptical of approving drugs based solely on foreign data, especially from China. We saw this with the sintilimab precedent,
Where the FDA essentially rejected a drug that had great data, but it lacked U.S. patient participation and diversity.
Exactly. So to counter this, Duggan launched massive global trials, HARMONi and HARMONi-3.
But the crucial recent news is that the data from these global trials, while it was trending positive, it missed statistical significance on the FDA's preferred gold standard metric.
Overall survival, OS.
This distinction is just so critical, it defines the entire regulatory risk. You as the listener, you really need to understand the difference here between PFS and OS.
It's everything. PSS, progression-free survival, means the tumor stopped growing or it shrank. You've delayed the disease's progression. OS, overall survival, means the patient actually lives statistically longer.
So why is the FDA so fixated on OS if the PFS is nearly 50% better? I mean, that seems like a huge win for patients.
Because PFS might mean we stabilize the disease for a few extra months, which is great, gives the patient quality time. But OS is the ultimate proof that the treatment fundamentally changes the patient's long-term trajectory.
The FDA is wary of approving treatments that just delay progression,
without actually extending life, especially if that drug introduces higher toxicity.
So Summit is currently in the statistical gray zone on the single most important metric for the FDA.
Which has dramatically increased the risk profile despite those incredible PFS results.
And that risk is compounded by the competition.
Right. The PD-1 by VEGF bispecific space is the hottest area in oncology right now. It's not just Summit.
Who else is in the running?
Biotech, with BNT327, has a competing asset moving through phase 3. Pfizer acquired a molecule specifically to get into this market, and you can bet that the reigning champions, Merck and AstraZeneca, are developing their own advanced combos.
But Summit does have that critical first-mover advantage.
They do. Ivonescimab is the first drug in this advanced tetravalent class to reach this level of phase 3 completion, and it's the first to show that head-to-head superiority data against Keytruda.
So they're arguably 1 to 2 years ahead of the closest competition.
Which is a massive head start. If they can clear this regulatory hurdle quickly, that lead could be worth billions.
So that's the incredible science and the colossal regulatory hurdle they're facing. But as we discussed, incredible science requires incredible execution and, maybe more importantly, incredible amounts of cash.
That's right.
So let's look at the financial and managerial war chest that's supporting this gamble. Chapter 2, Management Evaluation.
If you're investing in a developmental biotech, you are fundamentally betting on the jockey, not just the horse.
And in this case, the jockey is Robert W. Duggan.
A name that carries a lot of weight in this industry.
He's not just a successful executive, he is a bona fide legend. Let's talk about the Duggan playbook.
The playbook is, it's deceptively simple. You buy a deeply discounted, struggling asset. You pour money into clinical validation. You bring in the best team in the world to execute the trials, and then you sell for a massive premium.
And the classic example, the one everyone points to, is Pharmacyclics.
Right. Duggan bought into the company when it was essentially failing on the brink of collapse. He developed a blockbuster drug, Imbruvica, and then soared the company in 2015 for $21 billion.
$21 billion?
He turned a few $100 million into $21 billion in less than a decade. That track record is almost unparalleled. And it's the single biggest reason investors are giving Summit Therapeutics the benefit of the doubt today.
And he didn't just walk away from that success. He brought the team back with him.
He brought the band back together, yeah. His co-CEO, Dr. Moki Zangana, was the COO at Pharmacyclics. She was absolutely instrumental in that $21 billion sale.
So this is a proven, battle-tested leadership duo. They know how to navigate the complex world of FDA approvals and how to execute billion-dollar exits.
And their response to the current regulatory challenge just confirms their resilience. When the FDA signaled caution on using that China-only data, Duggan didn't pack up.
No, he pivoted instantly.
They aggressively launched these massive, costly global trials, HARMONi and HARMONi-3, to satisfy the FDA's demands for U.S. and global diversity. And at the same time, they raised huge amounts of capital to fund that acceleration. They are showing persistence under fire.
So let's dissect their capital allocation strategy. When a company has zero revenue, where the cash goes is everything.
And the focus is entirely on asset acquisition and R&D.
It started with that initial Akeso deal.
Right. That cost Summit $500 million up front back in December 2022. And it's crucial to note that Duggan largely financed that deal himself.
So this wasn't institutional money taking the first risk. This was the CEO putting his own fortune on the line from day one.
Exactly. And now they're pouring everything into validation. R&D expenses have just soared. They hit a staggering $103.4 million non-GAAP in Q3 2025 alone.
That massive burn rate reflects the sheer cost of running 3 separate large-scale global phase 3 trials at the same time, HARMONi, HARMONi-3, and now the new HARMONi-7.
Which is likely focused on those indication expansions, colorectal, breast cancer, and so on. They're trying to compress multi-year development cycle into the shortest time frame possible.
And in terms of shareholder signals, the company pays no dividends, which is what you'd expect.
Standard, yep.
But the key capital allocation signal, the really big one, is the massive insider commitment that happened in October 2025, that $500 million private placement.
This is where we need to dig in. The headline number is incredible. Duggan and Zangana committed $282 million of their own personal money to buy shares in that placement.
At $18.74 a share, which is just above the current market price of around $18.31. On the surface, it's a massive vote of confidence.
It is the strongest vote of confidence you could possibly imagine. It's practically shouting that the leadership believes the stock is undervalued at that price.
But, and your skepticism here is warranted, we have to acknowledge the mechanics of that private placement.
Right.
They raised $500 million. That is highly dilutive to existing shareholders. If the CEO and co-CEO didn't step in and absorb over half of that new equity,
the stock price would likely have collapsed.
Yeah.
Just from the supply shock of all those new shares hitting the market.
Exactly. So that $282 million commitment really serves 2 vital purposes.
First, as you said, it's a massive expression of conviction. They believe in the long-term success of the asset. But second, it's a sophisticated defense mechanism.
They are effectively buying back a huge chunk of shares at a guaranteed price to prevent market forces from punishing existing shareholders for the necessary dilution.
It stabilized the stock post-raise and essentially put a floor under the price around the time of the transaction. It shows masterful control of the capital markets.
So when we look at standard financial metrics for a company like this, like return on invested capital, ROIC, which is sitting at a negative TTM of negative 4.66%. It's totally irrelevant.
Absolutely irrelevant.
Yeah.
The company is designed to lose money until it generates its first dollar of sales. The only metric that matters for developmental biotech is the historical return based on market cap growth.
And for those early investors who bought in during the initial Duggan acquisition phase back in 2022.
The market cap has grown from roughly $200 million to $13.6 billion. That's a historical return of over 2,000%.
Wow.
That history of success is what buys the management team the confidence and the capital they need to execute this high-wire act today.
That history of execution is why the market is even considering a pre-revenue biotech as a $13.6 billion entity.
And before we dive deeper into the financial realities and the explosive market sentiment around this, let's just take a quick moment.
If you are finding this deep dive valuable, please remember that we deliver this kind of crucial analysis daily.
Like and subscribe to Stock Analytics AI.
And for even more detail, remember that for $44.99 a month, you get 500+ deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Now let's connect that strategic vision back to the current financial health of Summit.
Chapter 3, Financial Health. Okay, let's ground ourselves in the financial reality as of today, December 8th, 2025. We know the market cap is $13.6 billion, prices hovering around 18.31 cents.
And the simple truth is the revenue is effectively zero.
And because of that frantic pace of the global trials, the losses are actually accelerating.
They are. The net loss in Q3 2025 was $101 million. This translated to a loss of negative 13 cents per share, which was actually a bit wider than what analysts had been anticipating. A miss.
So if we quantify the damage, the free cash flow trend is steeply negative.
Right, with a consistent quarterly cash burn rate of around $100 million.
That's a high operational cost to maintain, especially when your timeline for commercialization is still dependent on a totally uncertain regulatory decision.
And this is where financial stability becomes absolutely paramount.
And if we connect this back to the Duggan playbook, they executed a flawless move to ensure that stability just 2 months ago.
They did. Duggan has always preferred funding growth through equity rather than debt, so the company's total debt is negligible. It's only about $5.42 million.
They are essentially debt-free.
Which provides immense operational flexibility. You don't have creditors breathing down your neck.
And that October 2025 $500 million raise was a masterstroke for their balance sheet. If we look at the pro forma cash position,
which combines the cash they had from Q3 plus the new capital.
They have approximately $746 million in their war chest.
And that cash position is critical. Their current ratio is extremely healthy. It's well over 10x after that raise. This war chest gives them funding stability through at least 2026 and probably deep into 2027.
So it doesn't matter how long the FDA's review takes.
Exactly. They have bought themselves time, which is the most valuable commodity in developmental biotech.
Now we arrive at the valuation reality check. Since there's zero revenue, metrics like the PE ratio are meaningless.
Negative, yeah.
But let's look at the price-to-book ratio, which is just astronomical. It's somewhere between 69 or 71 times. That number is just screaming at us.
That ratio is the clearest indicator of the whole dynamic here. A PB ratio of 70 times means you are paying $70 today for every $1 of tangible physical assets Summit has on its books.
The computers, the furniture,
the leftover chemicals in the lab. You are emphatically not buying the lab equipment. You're buying the intellectual property. You're buying the patent on that tetravalent structure and the hope that the FDA stamps that patent with commercial approval.
It's a pure expectation play. So since traditional metrics completely fail here, how do we even begin to establish intrinsic value for what is essentially a lottery ticket priced like a factory?
We have to turn to a more sophisticated, risk-adjusted approach. And that is an intrinsic valuation via a discounted cash flow model, a DCF.
And the key here is to explicitly incorporate that enormous clinical and regulatory risk right into the math.
You have to. And you do that by using a very high discount rate, or WACC, weighted average cost of capital.
Right. For a mature utility company, you might use a WACC of 6% or 7%.
But for a developmental biotech facing a binary regulatory event like this, you have to use a very high discount rate. We're talking something between 12 and 15%, reflecting that high probability of clinical failure or delay.
And the outcomes of that modeling are highly sensitive to the approval date and market share capture,
leading to a highly bifurcated outcome. There is no such thing as a median outcome here. It's one extreme or the other.
So let's detail that dramatic split, because this is what determines the whole investment thesis, if the bear case materializes.
Meaning the FDA issues a complete response letter, CRL, or demands new, multi-year overall survival studies.
The stock value collapses to the cash floor.
And that cash floor would price the stock somewhere between $5 and $8 per share. That reflects only the remaining cash minus liabilities. It would be a catastrophic loss of over 70% from current levels.
This is what the massive short position is betting on.
Absolutely. Then you have the base case.
Okay.
This assumes they gain approval in, say, late 2026 or early 2027. They successfully leverage that 49% PFS data, and they capture a modest but meaningful 10 to 15% of the first-line NSCLC market.
And what does that price the stock at?
That realistic scenario prices the stock somewhere between $25 and $35 per share. This accounts for the risk, but rewards the superior efficacy data.
And then there's the bull case, the Keytruda killer scenario. They achieve broad adoption, they capture 30% or more of the market share, and successfully expand into new indications like colorectal and breast cancer.
Well, that sends the value soaring to $50, or even $100 plus per share, is the definition of asymmetric upside.
And what's so fascinating is that the current analyst consensus target sits right in the middle of your base case.
Exactly. It's at $32.93. The current market price of $18.31 is clearly pricing in significant failure risk, or at the very least, an extreme regulatory delay that extends well beyond the analyst timeline.
Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion. Chapter 4, market sentiment. All right, let's transition now to how the public market is reacting to this extreme volatility and this fundamental uncertainty. We know the analyst consensus rating remains a confident buy.
It does, with an average target of $32.34, which implies a massive 76% upside from today's price.
But that consensus, it masks a tremendous polarization.
It really does. You have the aggressive bulls, funds like Guggenheim and Citigroup, and they're pushing targets up toward $40.
And that's based entirely on the superiority of the PFS data and the Duggan track record.
Right. But countering them is a highly unusual bearish call. We saw Barclays initiate coverage with an underweight rating and a low target of $16.
And
they're specifically citing competitive pressure from other bispecific developers and, crucially, the structural data risk caused by that OS miss in the global trial. The market is truly split right down the middle on whether the science is enough to overcome the regulatory hurdle.
And that tension is what fueled the enormous volatility we've seen.
Oh, absolutely. The stock experienced a massive surge. It soared 50% or more between May and September of 2025. That's when the magnitude of the 49% PFS win was fully internalized by investors.
But then the air started leaking out of the balloon in October.
October 2025, after the global Harmony data confirmed that miss on statistical significance for overall survival.
So the current market tone is one of cautious optimism.
Or maybe, better described as just holding their collective breath. Investors are waiting for the next binary catalyst, which is the FDA's decision on the biologics license application, the BLA filing.
And that waiting game is what's driving the extreme short interest. Let's talk about the short squeeze factor here.
The short interest in SMMT is abnormally high. It's sitting between 24 and 30% of the tradable float.
Which is roughly 31.2 million shares shorted.
That's right. And that level of shorting confirms that a huge chunk of the market believes this is a house of cards destined for that $5 at $8 cash floor.
But it also sets up a potential powder keg.
A huge one. If the BLA is accepted, or if they somehow deliver positive OS data in an updated analysis, the stock would experience a violent short squeeze.
Funds would scramble to cover 30 million shares.
And that would drive the price dramatically higher, potentially clearing the path to $35 or $40 almost instantly.
Conversely, if the FDA rejects the filing or issues a deep CRL,
that massive short position will absolutely crush the stock and quickly send it down toward that cash floor. That high short interest is the clearest indicator of the market's deep conviction in either the bull or the bear thesis. There's no middle ground.
And currently, the price of $18.31 is just consolidating. It's trading below its post-peak highs of $22 to $23, and it's near the bottom of its 52-week range.
Which suggests that despite management's personal conviction, the market remains deeply, deeply hesitant. That regulatory risk is being heavily priced into the current valuation.
Chapter 5, Ownership Structure. To really understand the volatility here and the strength of that insider signal, we have to analyze the ownership structure.
Which is very unusual.
Right. Summit has a highly concentrated structure for a company of its size. Institutional ownership is relatively low, around 13% to 14%, especially when you compare it to a big established pharmaceutical company.
The story here is the absolute insider dominance. Robert Duggan, the CEO, owns approximately 80% of the entire company.
80%.
And insider ownership overall is around 84%.
That level of concentration has two immediate effects for you, the retail investor. First, the tradable float is tiny.
Only about 103 million shares.
Yeah.
And that low float contributes directly to the extreme volatility. A large institution adding or subtracting even a few million shares can dramatically move the price.
And second, and maybe most importantly, the financial interests of the CEO and the shareholders are almost perfectly aligned.
Perfectly. Duggan loses 80 cents for every dollar the stock drops. His incentives are fully aligned with increasing the share price by getting this drug approved.
And the recent insider transactions provide one of the strongest bullish signals we've ever seen. We already talked about the magnitude of that $282 million personal commitment.
By Duggan and Zanganeh.
Right.
At $18.74 a share in October. That wasn't just a show of faith. That was personal capital exposure on a scale you rarely, if ever, see in the biotech industry.
And we also saw another director, Yushia, commit $10 million around the same time.
Right. But if we connect this to the smart money signal, we have to look at the specialized institutional buyers.
Okay.
The Biotech Specialist Fund, Baker Bros Advisors, has been significantly adding to their stake in Q2 and Q3 of 2025.
And Baker Bros is known for taking massive, high-risk, high-reward bets on developmental biotech.
They are. So when the funds that specialize in navigating this exact clinical landscape are buying alongside the CEO, it adds powerful validation to management's thesis.
The thesis that the drug's potential outweighs the regulatory risk.
Exactly. They're following Duggan's lead,
Yeah.
and they're betting that his legendary track record is going to prevail once again.
So we have this undeniable internal conviction, and it's backed by a historical 2,000% return for early investors.
But that confidence is fighting the biggest threats possible: regulatory scrutiny and geopolitics.
Chapter 6, Risk Assessment. All right, let's conduct a comprehensive risk assessment, starting with the internal strengths versus weaknesses, the classic SWOT analysis.
Okay.
Core strengths are pretty clear. It's the drug itself.
Ivonescimab has shown superior efficacy data that 49% PFS win against the incumbent champion.
We also have the unique tetravalent intellectual property, that scientific moat we talked about, and the highly experienced $21 billion proven leadership team. And crucially, that $740 million war chest gives them a strong cash cushion to withstand regulatory delays and continue funding their global trial.
Right. Now, on the flip side, the weaknesses. The most severe is that single asset risk.
Failure of Ivonescimab is synonymous with the collapse of Summit Therapeutics.
Period. They also currently rely heavily on partners, including their Chinese partner Akeso, for drug manufacturing and supply chain logistics. That's a big vulnerability.
So looking at the opportunities, the addressable market is gigantic.
It is. And beyond just NSCLC, the aggressive testing program and other high-value cancer indications, like the HARMONi-GI3 study for colorectal cancer, that promises multi-billion-dollar expansion potential.
And the high-value, fast exit opportunity is still there, the potential for a buyout.
Summit is a prime acquisition target. You have to think that big pharma players, especially Merck, who have a $25 billion franchise to protect.
They would rationally consider acquiring a best-in-class bispecific asset that has already proven its superiority in phase 3.
Just to take it off the market, or to integrate it into their own future pipeline. It could be a defensive or an offensive move.
Now for the threats. The first major internal threat is the safety profile.
Right. Ivonescimab showed a higher rate of severe side effects, grade 3 or higher treatment-related adverse events, at 29.4%. That's compared to Keytruda's 15.6%.
Which is almost double.
It's a known consequence of VEGF inhibition, but the FDA will heavily weigh this increased toxicity against that lack of statistical significance on overall survival.
Which brings us right back to the existential regulatory threat.
The primary worry is a complete response letter, or CRL, an outright rejection based on the lack of statistically significant OS data in the global trial.
Duggan's team is filing the BLA, and they're betting that the massive PFS benefit, combined with the safety profile being manageable, will be enough to compel approval.
But the risk of an extended review or an outright rejection is very high, especially given the current regulatory climate.
And that climate is now deeply intertwined with geopolitics. Summit's reliance on the Akeso licensing and manufacturing model is clashing directly with rising U.S.-China tensions.
Primarily driven by the Biosecure Act, which advanced in October 2025.
We need to unpack the specifics of the Biosecure Act here. While the current version doesn't specifically name Akeso as a company of concern,
the legislation signals a clear, hostile political climate aimed at reducing U.S. reliance on Chinese biotech entities. The stated goal is national security, avoiding dependency on foreign adversaries for critical medical supply chains and addressing concerns about data security.
This creates a critical and immediate supply chain risk for Summit.
It does. If the U.S. government targets the manufacturing of drugs by Chinese partners or bans them, which is a highly plausible outcome given the political momentum, Summit's supply of Ivonescimab could be completely severed.
And what does that mean for Summit? It necessitates a rapid, highly expensive, and technically complex process.
A tech transfer. They would need to immediately transfer the entire manufacturing process, from raw material sourcing to final formulation, to U.S. or European facilities.
And while that's certainly possible, it requires massive capital expenditure.
And it introduces significant risk of manufacturing delays and regulatory reapprovals. It's a huge headache.
Furthermore, you have the general economic factors, like the 10% U.S. tariffs imposed in 2025.
Right. While finished pharmaceuticals often get exemptions, the raw materials or specialized biotech services used by Akeso in the production process could be impacted.
So it complicates supply chain costs, adding margin pressure and logistics headaches.
Follow Summit as they try to manage a global supply chain during what is essentially a political freeze.
The company is facing not just a scientific test and a regulatory test, but also a geopolitical test that could sink the entire enterprise, regardless of how good the science is. Chapter 7.
Okay, let's synthesize this extraordinary deep dive. We have analyzed a company that is just defined by profound asymmetry. The potential rewards are astronomical, but the fundamental risks are existential.
The bull case is built on that superior head-to-head efficacy data, the 49% PFS win against Keytruda.
Paired with a proven management team that has delivered a $21 billion exit before.
And their willingness to back that thesis with a $282 million personal capital commitment is the clearest signal of management conviction you could possibly ask for.
They hold the first-mover advantage in a multi-billion-dollar market that they are aiming to completely disrupt.
The bear case, though, is equally potent.
It is. The ultimate regulatory hurdle of the overall survival data miss in the global trial, the high accelerating cash burn of $100 million per quarter, the severe single asset risk that makes approval a life-or-death moment.
And the massive, unpredictable geopolitical headwinds from the Biosecure Act and the hostility toward their China-dependent licensing model.
So let's restate the valuation against this backdrop. At the current share price of $18.31, Summit is trading at a significant discount to both the risk-adjusted intrinsic value of $28.25 and the analyst consensus.
The market is unequivocally pricing in substantial regulatory delay or outright failure.
It is. This is a classic asymmetric bet. The potential upside of reaching $50 plus per share vastly outweighs the downside risk, which is somewhat mitigated by that strong cash position at $5 to $8 per share.
Management's actions, particularly their financial commitment, suggest the market has dramatically overestimated the likelihood of complete failure.
They clearly believe they have a path to approval.
And that leads us to our concluding outlook and the final provocative thought for you, the listener. The Keytruda challenger, Ivonescimab, has the scientific data and the $21 billion proven leadership to pull off one of the greatest upsets in pharmaceutical history.
But the real question you have to grapple with is this. Can Robert Duggan's legendary track record and his enormous personal investment overcome the historical and political scrutiny the FDA is now placing on all Chinese-sourced biotech assets?
It's no longer just a fight between two drugs.
It's a fight against science, regulation, and massive geopolitical forces, all at the same time.
Thank you for joining us for this high-stakes deep dive into Summit Therapeutics. We hope this comprehensive analysis gives you a clear understanding of the complexity and the potential reward.
If you enjoyed this detailed analysis, please support our work.
Like and subscribe to Stock Analytics AI.
And please remember that this deep dive is for information and purposes only. It's based on AI research and analysis of sources as of December 8, 2025, and it does not constitute financial advice. All investment carries risk, including the loss of principal.
Please verify all data with official company filings before making any investment decision, and don't forget to subscribe.